Hi, I'm Neil McComb. I'm Portfolio Manager of Fiera's Diversified Futures Fund. A futures contract is an agreement between two investors to buy or sell something, referred to as an underlying, at a certain price agreed on now, but buying it or selling it at some time in the future. For example, let's say you have an investor who today wants to buy 100 ounces of gold in 3 weeks from investor B, but set the price today. An important point with futures contracts is that a futures contract will go up and down equally to the price of the underlying. For example, let's say today the S&P 500 goes up 1%. The futures contract on the S&P 500 should also go up roughly 1% as well. An investor who buys a futures contract is hoping for the market to go up and will profit as the market rises. An investor who sells a futures contract will profit if the market decreases. Now, like stocks, futures contracts trade on exchanges and they're guaranteed by the exchanges. But unlike stocks, futures contracts can just as easily be sold short, where you would benefit from a drop in price, just like going long, where you'd benefit from an increase in price. The strategy captures the gap between emotional markets and rational markets. If markets reflected all available information at any one time, markets would be perfectly rational and there would be no opportunities to profit from market behavior. Because emotions like fear and greed exist in markets, it is possible to find opportunities to profit from this behavior. Let's say the markets were to go up 20%. In a rational market, it would make sense for investors to be selling some of their shares because of the greater value. But in emotional markets, typically investors would probably rather be buying this because of emotions such as greed and because it feels more comfortable because everyone else is doing the same thing. This creates a gap between where markets should be trading and where markets actually trade. If markets were to fall 20%, the rational behavior would to be buying more stock because of the greater value presented by cheaper prices. Just like if something went on sale in a store, people are going to want to buy more and more. But in actual markets, in emotional markets, this is not the case, where the majority of people would look to be liquidating their portfolios. This creates a gap between emotional and rational markets, which presents us with opportunities to capture. It's important to note that in this strategy, every trade looks exactly the same. Let's use a falling market as an example. So first of all, trades are entered on a market breakout. So in this case, we have a downside breakout, so we will look to short the market. Now, at the time that we enter the trade, we have to calculate a stop and a target. The stop, which is going to be, in this case, above the entry price, is going to be calculated as a multiple of volatility. Now, for the target, which is going to be below the entry price because we're shorting the market, the target is simply calculated as a multiple of the stop. In this case, it's 4 times larger from the stop. So we've now calculated a stop above the market and a target below the market. At this point, the trade is going to be exited when the market reaches either the target or the stop, whichever comes first. This is what every single trade of the strategy looks like, and we then attempt to do hundreds of trades that look exactly the same each year. Let's say this strategy does 100 trades, and in the example that we just used, the targets are 4 times further away than the stops. How many times in 100 trades does the strategy have to make money in order to break even? Well, in this case, the answer is 20% of the time. If in 100 trades you win 20 times, and each time you make 4 units, or in this case, let's say $4, you would make $80. However, for the 80 losers that you have, where you lose $1 each, you would lose $80. $80 profit minus $80 loss equals a 0 net profit and break even. Now let's say with this strategy that you found a way to increase your winning percentage beyond break even. Let's say, for example, the strategy had 30 wins. In this case, the investor would show a profit because you would have 30 wins making $4 each, so that's $120. And you'd have 70 losses, losing $1 each with a $70 loss. $120 profit less $70 loss is a $50 profit after all the trades are done. The strategy identifies situations in emotional markets where it can reach its target more than break even. How does it do this? The strategy captures this gap between emotional markets and rational markets by using 4 price-based indicators. The 4 indicators are momentum, trend, deviation, and volatility. Momentum is simply looking at a market's short-term direction. This strategy buys as the market is going up, and it sells as the market's going down. The second one is trend. And what this strategy does is it buys in the direction of trend. If the long-term trend, which is essentially long-term momentum, if the trend is going up, the strategy prefers to buy. As the trend is going down, the strategy prefers to sell. The third one is called deviation. And simply what the strategy does is it looks at the current market price and compares it to some long-term average. This helps the strategy determine if there's too many positions on, which are highly correlated, or if there's enough room to add to existing positions. The final one is volatility. Specifically, the strategy is looking for markets that have extremely high or low volatility, in which cases the odds of reaching targets is significantly less. When all 4 of these price indicators line up, then a trade is going to be entered. The Fiera Futures Fund is a non-traditional investment that can replace a small part of someone's equity portfolio. The reasons are that it has 2 main objectives. The first is that it has equity-like characteristics. The strategy aims for equity-like returns, roughly 8% net of fees, equity-like volatility, but without the large drawdowns associated with a passive equity investment. The second objective is to have low correlation with traditional investments, low correlation with stock and bond investments, and specifically negative correlation with stocks in times of extended market turmoil. The portfolio is composed exclusively of exchange-traded futures contracts, trades 23 markets spanning all major sectors, including fixed income, equity indices, currencies, and commodities. To be included in the portfolio, only the most liquid products in the world from each sector are included in the portfolio. Since 2005, the strategy has generated interesting return characteristics. First of all, the strategy has outperformed equity and fixed income investments over that period. Second is that it has generated equity-like volatility. Third, it has had low correlation with equity investments. Fourth, it's had negative correlation with fixed income investments. And then finally, the last 2 points, which I think are the most interesting, is that it's generated negative correlation with equities when equities have been in times of market turmoil. The final point is that it has had drawdowns significantly less than passive equity investments. During the markets in 2008, where the S&P 500 had a 40% drawdown, this strategy had a drawdown of only 8%. The strategy manages risk in 2 distinct phases. The first phase is how to manage risk in an orderly market, or simply when the market allows you to act. So it takes a look at 3 major points. The first thing is the strategy limits risk in any one trade. Simply, every trade has a stop in place. The second thing is that the strategy limits risk in any one period, and it does that by having a stop on the month-to-date return. When the month-to-date return goes below 5%, all positions are cut in half, and if the month return were to fall below 7.5%, all trades would be closed and re-entered on the first of the next month. Historically, this final stop has never been triggered. The third thing is that the manages risk in any one drawdown. Very simply, the strategy reduces position size as the drawdown grows, and it does this at month end. For example, let's say last month the strategy lost 2%. All position sizes, winners and losers, would be reduced by 2%. Now, the second phase of this is how do you manage risk when the market is disorderly or dislocated? And this means that the market does not give you the opportunity to act. So what the strategy does, there's really only one thing to do, is manage exposure. And it does this in 2 ways. The first thing, it manages its leverage by keeping track of a ratio called the margin to equity ratio, simply how much capital in the fund is dedicated towards margin. And it's calibrated to have only 15% of capital dedicated towards margin. The second thing it does is it utilizes dynamic position sizing, which essentially makes risk between each market equal and lowers the risk within the entire portfolio. I hope you've enjoyed this brief presentation, and thank you for watching.